Gary, hello.
Hi, Leo.
Gary, the last couple of weeks I notice has been quite wobbly in the markets. There's been plenty going on in the news, wondering what's the cause. We're out of CO2. Is the FTSE 100 out of gas?
Don't think the FTSE 100's out of gas. I think you have to look at other markets around the world and certain sectors within those markets to see that they may be needing something to drive on from the heady levels they've already got to. And I know I keep going on about this, but there are some information community technology companies that are trading on pretty unreal long-term price earnings ratios now. But at the other end of it, you get some really good stocks that are quite cheap, and a lot of those you get within the FTSE 100 and the FTSE All Share Index. So I think you've got to be discerning in this market, because it really is a split market with regard the difference between the value metrics of the very expensive companies and those of the much better value companies.
Mm-hmm. So while all this market volatility is going on, we put out an article recently about the active versus passive investing. So if I'm a passive investor, which from my perspective I actually am, because I invest with Courtiers, I pay Courtiers to do it for me. I invest, I'm an investor, I do nothing. So surely that makes me passive. But how does this work when the markets are up and down and all over the place when you are active versus passive?
Well, let me say straight off, there is no such thing as passive investing. Those advocating that you buy their passive funds are doing so on the basis that Warren Buffett, the most active investor of all time, suggests that if he's not around in the future, then people could do a lot worse than putting all their money in an S&P 500 tracker fund. Well, first of all, you're making an active decision to be only in the American market. Secondly, when you do go to make that decision to be only in the American market, you will have a 23% exposure or thereabouts towards the big five tech stocks at the moment. Thirdly, you're going to have to make a decision as to whether you want your returns as an investor in this country in dollars or pounds. And the currency movement can have an almighty effect. And also, if you choose the American market, what about all the other markets that offer passive alternatives? Japan, Europe, FTSE 100. There are hundreds of indices that are so-called passive. So if you're a passive investor choosing passive funds, you've got to actively decide which one you're going to be in. So it's a complete joke to think that you can be passive. The only real passive would be that if you did nothing with your money, somehow it's in some homogeneous lump that everybody puts into, and that miraculously it will somehow find its way into a broad spread, which somehow meets your time horizon, which somehow meets your risk appetite. And that's a joke. There's no such thing as, even you, Leo, you've chosen to put your money in Courtiers funds, but that's an active decision. Courtiers doesn't force you to do it, and it's probably a mark of the fact that you're as close to these funds as anybody because you work within the organisation and you choose to do it. All of my money and my family's money is in Courtiers funds. I do not choose to stick them in passive funds with lower costs, because I would much rather have all the risk controls and all the spread of asset classes that our funds achieve. And whilst we've not been at this quite as long as Warren Buffett, and Jamie and I might not be worth quite as much as Warren Buffett, we've still been at this nearly 40 years. So clients have been entrusting us with their money since 1982. And I think that shows that actively you're doing the job properly, that clients trust you.
Well, let me just make this point, Gary, that while I genuinely do consider myself a passive investor, because I put my money with the Courtiers, I don't think about it. I don't worry about it. Whereas on the other hand, I can imagine what I consider to be a passive investor and how I understand it. They might be awake at night thinking, where is my money? What's happening with it? Where's it gone to? Is it meeting my horizons, etc., etc.?
Yeah, you could say, Leo, that you can sleep at night because I can't. I do all the worrying for you. That's what you pay for.
Well, I know there's
sense,
active investing. Yeah.
Yeah, yes, absolutely. That is what our clients pay for. They pay for us to be active and the investment team to be very active. And they pay for their account managers to make sure they've got their risk profiling correct. And they pay us to make sure we've got the tax structures correct. And that succession planning is in place properly. And that when succession does take place, that the wills and everything are structured to minimise the amount of inheritance tax. I mean, you get that wrong, it's 40% of assets unnecessarily in a lot of cases. So, yeah, if you can do all that yourself, great, it's fine. But there's an old adage, isn't there? He who advises himself has a fool for a client. So it's always helpful to have somebody externally look at things. Believe it or not, I mean, I have an account manager at Courtiers. I don't do our own planning of our family's finances because I want a third party to look at it. So, Warren Buffett doesn't believe in passive investing. He's never done that. Anybody reads security analysis, read what Ben Graham, his mentor, says. He does not believe in passive investing. He believes in thorough analysis and buying assets that have a margin of safety. And that is what we do. Diversify and go for a margin of safety. And why do we diversify? Because we can't get every decision right. And what you don't want to be is piled into the one stock that goes massively wrong, or get over concentrated in certain illiquid stocks, as an investor like Woodford did. And it has disastrous consequences. So no, I am passionately active, Leo, not passive.
Well, I think around the active investing, you also have the active understanding, don't you, of those supporting the managers, the advisors, and actively thinking about how circumstances change through the course of life. So you're on the ball with it. Gary, I just wanted to close by asking how things are going then in the Courtiers funds. What sort of strategies have you got going off? Are there any new stocks that you've been looking at?
We're trying to steer away from the more expensive ends of the market. Let's face it, we've had a blindingly good 12 months. It was good across markets. We did very well. We got another award, which was terrific. But it's going to be tough to repeat that because obviously you haven't got the rock bottom prices that you had in the summer of 2020. So what we're trying to do is be careful of the stocks that are getting overvalued. We had a meeting this morning about looking at a variety of stocks, and there are a lot of very, very good opportunities out there in different sectors and around the world. But we're very mindful of the possibility that if interest rates start to rise, some stocks could look very pricey, and we don't want to be exposed to those unnecessarily. But so it's very interesting times because you've got the haves and the have-nots. You've got the very expensive stocks and the very low value stocks, and we're trying to be in amongst the lower value stuff while still keeping a good diversification and not being too exposed to rising interest rates.
Sure. Gary, we'll leave it there. Thanks very much for your time, and thanks for actively managing the peaks and troughs of my investments. I shall speak to you soon.
A pleasure. Thanks, Leah. Thanks.
Take care.
Bye.